2.6 million people just had their student loans sent to collections in just 3 months. And if you're carrying student debt right now, you could be next. The pandemic pause is over. The grace period has ended. And what's happening to people's finances right now is actually devastating. Welcome back. I'm breaking down exactly what's happening with federal student loans in 2026, why it matters to your wallet, and what you need to do right now if you're affected. Here's what the Federal Reserve just reported. In the first quarter of 2026 alone, approximately 2.6 million federal student loan borrowers were transferred to the Department of Education's Default Resolution Group. That means their loans officially went into default. And this isn't a one-time spike. In the last quarter of 2025, another 1 million borrowers defaulted. We're talking about millions of people facing serious financial consequences right now. But here's what makes this even worse. Most of these people aren't irresponsible deadbeats. The average person who defaulted on their loans in 2026 is 39 years old. These are working adults. These are people with jobs, with families, with responsibilities. Many of them were actually current on their loans before the pandemic. They had their payments figured out. So what changed? Life happened. Inflation hit hard. Rent went up 3.3% annually. Food prices jumped 3.2%. Childcare costs exploded. Maybe they got laid off. Maybe their hours were cut. Maybe they had a medical emergency. The point is, they couldn't keep up. And when that student loan payment came due after the pandemic pause, it broke them. The damage happens fast. Really fast. When your loan goes into default, your credit score doesn't just drop a little. It gets absolutely destroyed. Here's the number. Credit scores for defaulted borrowers dropped an average of 91 points. Not 20 points. Not 50 points. 91 points. Think about what a 91-point credit score drop means. Your interest rates go up on everything. A credit card you already have? The interest rate increases. Want to finance a car? You're paying 2 to 3% more in interest. Want a mortgage? You're either denied or paying thousands more per year. Insurance companies pull your credit too. You're paying higher premiums on car and home insurance. And this isn't some small mark on your report that disappears in a year. Default stays on your credit report for 7 years. 7 years. That's 7 years of paying more, getting rejected, and struggling to build financial stability. Here's the thing about federal student loan debt that most people don't understand. It's not like credit card debt or a personal loan. The government has superpowers that regular creditors don't have. When your student loans go into default, the entire remaining balance becomes due immediately. Not your monthly payment. The entire balance. Your loan servicer can then pursue wage garnishment. That means the government can take money directly out of your paycheck before you even see it. They can garnish up to 15% of your disposable income. But it gets worse. The government can seize your tax refunds. If you're supposed to get a $3,000 tax refund, gone. Taken. They can also intercept unemployment checks. If you lost your job and qualified for unemployment benefits, they take that too. And if you're retired and collecting Social Security, they can even garnish those benefits. Then, on top of everything, collections agencies add fees, penalty fees, collection fees, late fees. So now you're not paying off the original $50,000 loan anymore. You're paying $50,000 plus $10,000 in penalties. You're paying interest that's been accruing while you weren't making payments. This is why student loan default is so much more serious than other types of debt. The government isn't playing around. They have legal authority that other creditors don't have. If you have federal student loans and you're struggling to make payments, here's what you need to do. Call your loan servicer today. Not tomorrow. Today. Before you miss a payment. You have options that most people don't know about. Income-driven repayment plans can lower your monthly payment to as low as $0. Zero. If your income is low enough, the government will basically pause your payments and focus on interest. You can also consolidate your loans, which extends your repayment timeline and can lower your monthly payment. You can request deferment or forbearance, which temporarily pauses your payments while you get back on your feet. But here's the catch. You have to apply for these options before you default. Once you're in default, it's much harder to get out. And if you're already in default, It's not the end of the world. You can rehabilitate your loans. Make 9 reasonable payments over 10 months, and your loan comes out of default. After that, the default notation can potentially be removed from your credit report. It's not fun, but it's possible. The key is, act before default, or act immediately after. Don't ignore letters from the Department of Education. Don't pretend the problem will go away. It won't. Student loan defaults are going to hit millions more people in the coming months, as inflation and cost of living pressures continue. If you're struggling with student debt, this is your sign to take action today. Call your loan servicer. Explore income-driven repayment. Look into consolidation. Do something. Because ignoring this will cost you thousands of dollars in the long run. And if you found this helpful, share it with anyone you know dealing with student debt. They need to see this. Thanks for watching.